All right, today we're pulling back the curtain on your ETFs. We're going to dig into what's really inside them, what the holdings are, and how that whole diversification thing actually works to protect your money. Let's jump right in. So, picture this. You click buy on a popular ETF. You're feeling pretty good about it, right? Smart, diversified, but did you ever stop and ask yourself, what did I just actually buy? What's really inside that thing? Well, that's exactly what we're about to unpack. Okay, so to answer that question, we've got to pry open the box, so to speak, and really understand what we're talking about when we say ETF holdings. At its core, it's actually pretty simple. ETF holdings are just all the individual things, stocks from companies, bonds from governments, all that stuff, that the fund owns for you. And one of the best parts about ETFs is how transparent they are. They usually publish what they own every single day, so you always know exactly what you've got. A really great way to think about it is like a huge, well-stocked pantry. Instead of going out and buying just one ingredient, like a single stock, you're buying the whole pantry, already filled with thousands of different items, all ready to help you cook up whatever financial goal you have in mind. And when I say a huge pantry, I am not kidding. A single broad market ETF, say one that tracks the entire US stock market, can hold over 3,000 individual stocks. And it's this incredible scale that unlocks their most powerful benefit. Which brings us right here to what I like to call the diversification shield. This is all about how holding so many different things actually lowers your risk. This, right here, is the real superpower of an ETF. And this quote just nails it. You've heard it a million times, right? Don't put all your eggs in one basket. That's the whole idea. By spreading your money across hundreds or even thousands of different companies, you're building a shield against any one of them having a really bad day. And to see just how important this is, just imagine for a second that a stock you own has a terrible announcement, and bam, its price gets cut in half. If that was the only stock you owned, that's a catastrophe. Your entire portfolio just lost 50% of its value. But inside an ETF, that same exact event is just a tiny, tiny ripple in a very large ocean. And here's the math, and honestly, it's just so powerful. That 50% drop is devastating if you own the stock directly. But look what happens inside an ETF with, say, 500 stocks. That massive 50% loss is spread so thin that it only causes a tiny 0.1% dip in the entire fund. That is the diversification shield in action. It just mathematically softens the blow. But it's not just about the sheer number of companies. Real diversification has layers. You want different industries, tech, but also healthcare and energy. You probably want exposure to different parts of the world, the US, Europe, Asia. And you might even want different types of assets, like a mix of stocks and bonds. Okay, so you get the theory. Now, how do you actually apply it? This next part is all about giving you a practical toolkit you can use to check out any ETF for yourself. You can really evaluate any ETF with this simple 3-point checkup. First, just look at the total number of holdings. Is it a lot or a little? Second, and this is key, check the concentration. How much of the fund is packed into its top 10 biggest holdings? And finally, review the sector breakdown. Does it fit what you're trying to do? Now, that second point about concentration helps you spot this kind of sneaky problem called concentration risk. This is what happens when an ETF might own hundreds of stocks, but its value is totally dominated by just a handful of giant companies. You see this a lot in funds where the biggest companies get the biggest share, which can make the fund way less diversified than it looks on the surface. And here's what that looks like. In this example, just 10 companies make up a whopping 45% of the entire fund's value. That means the performance of those 10 companies is going to have a huge, outsized impact on your investment, which kind of defeats the whole point of diversification. It's a really critical thing to check for. So, let's wrap this all up. At the end of the day, what's the most important thing for a smart investor to take away from all this? It really comes down to this. Knowing what's inside your ETF isn't just about looking at data for fun. It's about control. It's what transforms you from just being a passive owner to being an informed investor who's actually in the driver's seat. So I'll leave you with one final, and I think pretty important question. After all of this, take a hard look at your own investments and ask yourself, is my portfolio really as diversified as I think it is? The good news is you now have the tools to find out.